Hi, in the previous accounting lectures, we have covered the basic terms of the accounting. Now we are left with accounting principles. This accounting principle will lead you to gain a marks of 4 to 5 directly very easy questions from this section. So it is very important. Do watch this video completely. Don't miss even a single part of this video. Okay, now today we will discuss three basic principles of accounting. Okay, accounting principles, accounting principle concepts and conventions commonly known as generally accepted accounting principles or CAAPs. Remember, it is generally accepted accounting principles are the basic rules that define the parameters and the constraints with which accounting operates. In simple words, it is nothing but it will defines the parameters as well as the rules according to which you need to form or frame your accounting, or you need to maintain your accounting books. In India, the Institute of Chartered Accountants of India has issued accounting standards. In India, ICAI has issued accounting standards. Do remember, initially this ICAI accounting standards was not mandatory. It was just a voluntary. Okay, it was just a voluntary. But in recent times, it has made it mandatory. It has made it mandatory. But if at all you are a single owner of your single shop, okay, you are a single owner of your shop, that may be a cotton shop or it may be a grocery shop, then you will follow this Institute of Chartered Accountants of India accounting standards. But whereas if at all it is an organization in India and it has been registered under Companies Act of 2013, then the accounting principle will be followed according to the Act mentioned 2013. It has mentioned some of the accounting standards, or it has notified those, and it is mandatory for the companies who are registered under Companies Act of 2013 to follow these accounting standards. Now, fundamental accounting assumptions. Okay, now we will deal with three of the assumptions. First, the fundamental accounting assumptions. The following are recorded as AS1. There are three types of AS1, AS2 and AS3. Okay, in further lectures we will deal with this, but first of all, now we will see what are the principles or assumptions. First is going concern assumptions. Going concern assumption. Before reading the definition, we will understand with an example. Just imagine that you are running an organization and you have bought a machine of 10 lakh rupees with the thinking that this 10 lakh machine in further 10 years it will gain you 20 lakh rupees, right? Why you are assuming this? Because you are assuming that your company will not at all close within this 10 years period. This is nothing but the going concern assumptions. Now we will understand with the definition. The concept assumes that a business entity will continue to operate indefinitely. We have taken an example of 10 years, but anyway, the organization will think that it will not at all close. It will run for an indefinite period, and that it will not be liquidated in the immediate future. That means it will not be closed. It will not be closed within a span of 1 year or 2 years. But the assumption is that it will run for an indefinite period. And the financial statements are prepared on this assumptions, and this assumption is nothing but going concern assumptions. Okay, it's very simple. Hope you have understood. It's nothing but assuming that your organization will run for an indefinite period. This is going concern assumption. The business is called going concern. The business is called going concern, which means that it will remain in operation in the foreseeable future unless it is to be liquidated in the near future. That means it will not close in near future. Since this concept believes in the continuity of the business, it will believes in the continuity of business over indefinite period. It is also known as continuity concept. It's very important. Going concern concept is assumption is also called as continuity concept. Okay, continuity concept. It is also known as continuity concept. It is because of the going concern concept that distinction between, because this, see, in the initial lecturers we have seen that there are two types of capital expenditures. One is revenue expenditure, another is capital expenditure. Okay, capital expenditure is for a whole period. That means you are assuming that this capital expenditure will help your organization for the near future. The revenue expenditure is for the immediate gain of the profit. But whereas capital expenditure is, we assume that this capital expenditure will help us in the near future to gain more money. Okay. Now, this is the differentiation of assets. That is, it is a short term asset, it is a long term asset. And the going concern concept, it is called continuous concept because it will differentiate the fixed asset as well as current assets. Okay, it will differentiate fixed asset as well as current assets. Next, it will differentiate between short term and long term liabilities. It will differentiate between short term and long term liabilities. What is the difference? Short term is nothing but you need to pay within a period of 1 year. You need to pay within a period of 1 year, whereas long term liability is nothing but you can pay it after more than 1 year. That is, you can pay the amount back to the bank or from the organization where you have taken the loan after a period of 1 year, but not within a period of 1 year. This going concern concept or assumption will differentiate between short term and long term liabilities. Next, the third, capital and revenue expenditure are made. This will also differentiate between capital as well as revenue expenditure that has been made by the organization. Next, the second assumption that we need to discuss is consistency assumption. Consistency assumption. We will first see the definition, then we will try to understand it with a simple example. Accounting practices, once selected and adopted, should be applied consistently year after year. Reread the sentence. Accounting practices, once selected and adopted, should be applied consistently year after year. It helps in elimination of personal bias and helps in showing results that are comparable. The consistency principle of accounting states companies should use the same accounting policies and methods for recording similar events or transactions from financial period to another. From one financial period to another. Now we will try to understand this with an example. If at all in accounting you are mentioning that you have created an asset, okay, you have bought a machine of 10 lakh rupees in 2010. Okay, in your accounting book you are mentioning that this 10 lakh is used as an asset that you have brought. Okay, in 2012 you need to depreciate the amount that is lost within this 2 years. Okay, because this 10 lakh rupees machine is now costing you, or if at all you are going to resell it, you are gaining only 8 lakh rupees. That means there is a 2 lakh depreciation amount that need to be mentioned in the accounting book. In the third year, that is in the 2013, if you are reselling that machine and you are getting 7 lakh rupees, then there is a depreciation of 3 lakh. What you are doing, you are depreciating this amount considering that this was the 10 lakh machine. Okay, this is a straight line method. Just imagine, because you are taking the cost amount in order to depreciate the amount that is lost within 2 or 3 years. Now there is another one method called write down method. The graph will be in the downward direction. Just imagine that your machine cost is 10 lakh rupees. In 1 year the depreciation amount is 10%, that is it will get to 9 lakh rupees. Okay, in the period of 2011. But in the year 2012 the depreciation amount is again 10% on the 9 lakh rupees. What is the depreciation amount? The machine cost will get to 8.1 lakh rupees. 8.1 lakh rupees. Now continuance of this following methods. One is straight line method and another one is write down method. Write down valuation method. The continuation of these methods will lead to consistency assumption. That means in the accounting you should follow a single method. You should not jumble this with one. For the first year you should measure it on the straight line method. Then on the second year you should measure it on the write down valuation method. There will be no consistency. The accounting principle states that you should follow the consistency method. But the consistency method is not so stringent. If at all there is a requirement, you can move from straight line method to write down valuation method. Okay. In simple terms, it is consistency assumption. Then, what is accrual assumption? What is accrual assumption? This is the third assumption that we are learning in this lecture. There are many more assumptions we will be seeing in the future lecturers. First, we will try to understand this with definition. What is accrual assumption? The essence of actual accrual concept is that revenue is recognized when it is occurred or realized. Revenue is recognized when it is occurred or realized. Okay, we will try to understand it very simple example. Just imagine that you have purchased 10 cloths, okay, and you have the actual cost of the 10 cloths is 100 rupees. Okay, what you will say, I will pay this amount after 2 days. Okay, but at present you have got 10 cloths. Now in the accounting book, what is to be made is that this 10 cloths has already been credited to your account, although you have not paid 100 rupees to the supplier. Okay, but you have got 10 cloths in your account, and it should be mentioned in your accounting book on the day itself when you got those 10 cloths. This is nothing but accrual assumption. That is, the concept is that revenue is recognized when it is occurred or realized. Even if you are going to pay the 100 rupees after 6 months, although you should mention the amount, the clothes that you have got on the day itself into your accounting book. This is nothing but accrual assumption. See, when sale is completed or services are given, and it is immaterial whether cash is received or not. That means you have purchased a service, you have paid a cash or not, it doesn't matter, but the service has been taken, it should be mentioned in your accounting book. Similarly, according to this concept, expenses are recognized in the accounting period in which they help in earning the revenues whether cash is paid or not. That means if at all you have hired an employee, then you should pay him the monthly income or monthly salary, right? But what you will do, you will 10 lakh rupees you should pay, but you will not pay, 10,000 rupees you should pay per month. Okay, but you will not pay it in the initial month itself, but you will pay it after 2 months to the employee. Although you have not paid this amount, but it should be mentioned in your accounting that amount has been paid. This is nothing but accrual assumption concept. If at all you are unable to understand, do comment. We will try to answer your queries, and the PDF will be provided in the Telegram channel. So do join the Telegram channel. The link is provided in description. Now we will do some of the MCQs. The first MCQ is, a person who owes OWES, that means I need to pay money for him. I am a person, I have taken a loan of 5 lakh rupees from this person. Now I should pay 5 lakh rupees to him. That means I owe money for him. A person who owes money to a firm against goods, sold is called. A person who owes money, that means I owe money to a firm against goods sold is called a debtor. He is called a debtor. Who is creditor here? The person who has given money to you is a creditor for you. Okay, but you are a debtor for him. Next, revenue from operation refers to, what does the revenue from operation? Revenue from operation refers to revenue earned from operating activities. We have discussed what is difference between revenue, income in the previous lecture. You can watch those lectures, then this will be easy for you to answer the questions. Revenue from an operation is, answer is revenue earned from operating activities. I have told you, you have sold cloths of 5 lakh rupees. Okay, and you have gained, you have brought this clothes in 4 lakh rupees. The difference is 1 lakh rupee. What is this? This is profit. Okay, but this 5 lakh is revenue for you. Okay, 4 lakh is the cost, 1 lakh is the profit, and 5 lakh is the revenue. And this is the answer, revenue earned from the operating activities. Fine. Next, third, according to going concern concepts. According to going concern concepts, what is the actual answer? You can read the options that have been given. You can pause the video and you can read the options. But here the answer is assets are recorded at a cost and are depreciated over their useful life. Okay, that means I told you, you are taking a machine at 10 lakh rupees in 2010. Although this machine rate is 8 lakh rupees in 2011, but you should consider the cost that have been mentioned in your accounting books, and that is 10 lakh. And this is mentioned by or taken as an assumption by going concern concept. Fourth, according to convention of consistency, I told you there are two types of method. One is straight line method and another one is write down valuation method. This is covered by consistency or convention of consistency. According to convention of consistency, you can read the options, you can pause the video. Here the answer is accounting policies and practices once adopted should be consistently followed. That is, I told you we should not jumble this. If at all we are following a straight line method, then for lifelong we should follow this. Or if at all we are following a write down valuation method, then also we should follow this. But we should not interchange these. Then fifth question. So the fifth question is X Limited. There is a company called X Limited follows the written down method of depreciating machinery year after year due to. It will follow a written down method of depreciating machinery year after year. That is, it is following consistency year after year. It is following the same method. Then the answer is consistency. So these are the 5 MCQ questions that we have discussed on the previous lecturers. You can watch all those lecturers and we have provided a playlist on our YouTube channel. You can subscribe the official channel as well as press the bell icon. If you need PDF of these files, do join the Telegram channel. Thanks for watching the video. All the best for examinations.